Well, JP Morgan President Daniel Pinto said today at the bank's Investor Day that it's, quote, very unlikely that we won't see a recession this year. So how can investors build wealth amid this economic uncertainty? Our next guest has a few tips for us. Joining us now is Anthony Saccaro, Providence Financial and Insurance Services President. Thank you for joining me this morning here. So in terms of what investors are focused on, of all the things they have to focus on at the moment, inflation still tops the list. Talk about the concerns that they have there.
Yeah, inflation is still the number one concern of the market overall. The fact is that there's been some signs that inflation is coming down. The consumer's starting to weaken. GDP numbers are weakening, got cut big time. But it's still the number one concern going forward in the long run.
And so then if you're trying to invest and build wealth in this sort of environment, depending on your timeline to retirement, what should you be prioritizing?
So I think you have to look at life in four different stages, long-term and short-term for the brevity. If you have more than 20 years, I think there's two ways to really build significant wealth. One is through real estate, great investment. You get some tax advantages. You get other people paying off your mortgages. I think it's a great way long run. And the goal should be to have your real estate paid off by the time you actually get to retirement. So now you can turn what is a wealth builder into an income cash flow machine. So I think that's a great way. The con is you've got to deal with tenants and they could be very expensive as well. Stocks are the other way. For most people, that's going to be the most viable way. And dollar cost averaging into stocks, buying over and over and over and over again, drives the average share price down. And it's been shown that dollar cost averaging over a long period of time is going to help you build significant wealth. The simple fact is that time is your friend, time is on your side when you're dollar cost averaging, and by buying the same thing over and over again with the same dollar amount, you drive the average purchase price down. And that's the whole goal in the market is to buy low. So if you're older, if you're younger, you have a long time to go, dollar cost averaging. If you're older in retirement, you need to shift that. You need to be focusing on investments that are going to pay you income. If you're in retirement and you're not buying shares periodically, you're probably selling shares periodically, and it has the reverse effect of dollar cost averaging. You're not buying low, you're actually selling low. And I won't take time to go through the math behind that, but the strategies that are used to get you to retirement are completely different than the strategies that are used in retirement. And the biggest mistake I see investors make and pre-retirees make is as they get closer to retirement, as their life makes a paradigm shift from putting money in to taking money out, they don't make a shift with their portfolio. And for the last decade and a half, you've gotten away with it. But for the next decade or decade and a half, who knows? I'm not so confident.
And I mean, when you look at sort of where we're looking at fiscal policy, I mean, we still have a long road to go to the Fed's 2% inflation target. So how are you viewing some of these economic risks when we know that the Fed has indicated it's more willing to over-tighten and sort of see some cracks in the economy versus under-tightening and then risking having to re-hike interest rates again?
Yeah, the fact is that the Fed is in really kind of a pickle at this point. They have to choose between the lesser of two evils. They have to choose between trying to get inflation down, and they have to then choose between whether they're going to cause a recession or not. And they've made it very clear over the past months that the lesser evil is the recession. Now, no one wants a recession, but the interesting thing is they really want a recession, but they're not saying they want a recession. The whole point is to drive down economic growth so you can drive down inflation, get it in that 2% level. And in order to do that, you want things to slow down. And a recession, the very definition is a slower economy. So you want it, but you don't want it. They're talking out of both sides of their mouth. I think we could have a mild recession coming up. Whether the Federal Reserve raises interest rates this next time or not, I think a pause is okay because inflation is a lagging indicator. I think they should pause, but I don't see a rate cut in the future. There's a lot of economists predicting at the end of this year or beginning of next year, a rate cut. Well, I don't see any purpose for a rate cut unless inflation gets down to 2% or unless the stock market goes crazy. And the latter is more likely, unfortunately.
And we know that in light of what we saw with the recent banking fallout, a lot of customers sort of going out there trying to chase some of these high yields. What are some of the biggest mistakes you're seeing people make right now? Some of these knee-jerk reactions?
Yeah, absolutely. I think that one of the biggest mistakes that I see is that they're using funds to chase these high yields. Funds don't give you the guarantees of owning the individual investments. A bond fund has no guarantee of your principal at all. And a lot of people have learned the hard way now with interest rates having skyrocketed over the last year and a half that you can actually lose money in treasuries. I mean, just ask Silicon Valley Bank, right? But a lot of people, when they put their money into these bond funds, they don't realize that they could actually lose money. So it's a mistake. If you buy individual investments like bonds or like some of the other things that promise or even guarantee some kind of rates of return, you're going to be better off. So individual investments generally better than funds, and not diversifying. A lot of people who are chasing yield in the equity market will put a ton of their money into one particular company or maybe 4 or 5 different companies, and anything can happen with those companies. And instead of buying a value play, they might be buying a value trap, and that could be devastating if you're not diversified. So those are 2 big common mistakes that I see.
We appreciate you joining us. Lots of great tips there. Anthony Saccaro, thank you so much.